Imagine walking into a giant supermarket filled with thousands of products. It's overwhelming, right? That's what investing feels like for many people. You open up your brokerage app, and there are thousands of stocks, hundreds of ETFs, and countless opinions on which is the best. Some people swear by Tesla. Others say Apple is the only stock worth holding. SCHD has become a cult favorite. There are other options, often better ones, if you look a little deeper. In 2025, it might not be SCHD. SCHD, the Schwab U.S. Dividend Equity ETF, gained massive popularity because it offers solid dividend-paying stocks and a low expense ratio. But here's the catch. SCHD is built for yesterday's world more than tomorrow's, leaning into sectors like consumer staples and financials. If SCHD isn't the one ETF to buy in 2025, where should you look? Understanding growth areas is essential. Experts recommend ETFs tracking broader markets or innovative sectors. A top pick is VOO, the Vanguard S&P 500 ETF. VOO provides instant access to 500 of the largest U.S. companies, from Apple to Amazon. It's buying the entire economy's growth. While SCHD offers dividends, it limits upside in a world dominated by innovation. VOO opens doors to tech leaders and pioneers. What about more specialized options? QQQ, following the NASDAQ 100, focuses heavily on tech and growth. For long-term growth, consider QQQ. If you believe in AI, green energy, and biotech, higher volatility means greater potential rewards. Let's address the elephant in the room: dividends. One reason investors love SCHD is its juicy yield. Those quarterly checks provide comfort. But a 3 to 4% yield means little if your portfolio lags the market. Would you take $3,000 in dividends or watch $100,000 double in 10 years? VOO or QQQ may offer smaller dividends, but their growth potential can exceed SCHD's payout significantly. Next, let's talk about diversification. SCHD's sector concentration limits your protection. In 2022, it held up, but it lagged in 2023 to 2024 as tech rebounded. By choosing broader funds like VOO or growth-oriented ones like QQQ, you diversify across industries and align with future opportunities. Finally, consider the global outlook. Supply chains are changing, and emerging markets like India are gaining strength. Diversification beyond U.S. borders is crucial. In 2025, one investor buys SCHD for perceived safety and steady dividends, while another invests in VOO or QQQ, aiming for growth. Fast forward 10 years, and the SCHD investor has steady checks, but the growth investor sees their portfolio double or triple. Once your portfolio grows, you can switch to income-focused ETFs later. Growth first, income later is smarter for under-retirement age. Humans love certainty, which is why SCHD feels good. But investing is about long-term outcomes, not immediate gratification. Choosing VOO or QQQ requires patience, as you won't get instant dividends, but you're positioning for greater long-term success. SCHD's popularity on social media doesn't equal performance. Trendy investments often signal diminishing returns. SCHD has done fine, but hasn't matched VOO or QQQ's decade-long performance. Future growth is driven by technology and healthcare. If I can only buy one ETF in 2025, it's either VOO for long-term growth or QQQ for innovation, not SCHD. Investing aligns your money with the future. SCHD offers stability but represents yesterday's economy. VOO and QQQ provide exposure to technology, innovation, and global growth. Invest where the growth is. Don't just pick the popular ETF. Consider where your money will work hardest for you. Leaning on SCHD could hold you back in 2025 as the global economy evolves towards resilience and technology. Broad market ETFs like VOO or growth-focused like QQQ give you exposure to the leaders of tomorrow. Millennials and Gen Z are stepping into prime earning years. Their preferences are reshaping markets, focusing on tech, sustainability, and digital transformation. Billions in capital towards sustainable industries mean broader market ETFs benefit more than dividend-weighted products like SCHD. Younger consumers prefer Tesla over Ford and plant-based proteins instead of meat, creating ripples across industries. Innovations in ETFs include active strategies, thematic ETFs, and global funds. Ignoring these can close investors off from rising opportunities. Volatility could be an opportunity for long-term investors. It allows buying shares at lower prices, unlike safer, less volatile investments. Avoiding volatility often leads to missing out on growth. Just like a roller coaster, riding the market's ups and downs can lead to greater rewards. We need to address the inflationary backdrop. The 2020s are shaping up to be a decade of higher structural inflation than the 2010s. Governments are spending heavily on infrastructure, defense, and climate initiatives. That money often fuels sectors like energy, technology, and materials. Funds like SCHD may capture a slice of that, but don't give you the full benefit of those policy-driven growth stories. Broad-based ETF like VOO captures all of it, holding a little bit of everything, including companies benefiting from government spending. Let's not ignore the rise of China, India, and other emerging economies. The future will be multipolar. While the US remains dominant, companies in India are growing rapidly, especially in tech and manufacturing. If you only hold SCHD, you're blind to developments in India, Africa, and Latin America. Adding ETFs like VXUS or VWO ensures a broader perspective. Investors often feel comforted by dividends, luring them into complacency. This can lead to holding on to a mediocre investment, even as the opportunity cost grows. Prioritize total return first, then shift to dividend-focused funds once your portfolio grows. Growth first, income later is the way to build wealth. We are in the early phases of AI, quantum computing, and renewables. Ignoring these megatrends is akin to missing out on the internet boom. ETFs like QQQ and thematic funds like ARKK provide exposure to innovations. SCHD may leave you behind in the evolving market landscape. Historical returns show that growth-focused indexes outperform dividend-focused ones over time. Stability versus wealth. Choose wisely. Thanks for watching. If you found this useful, like, share, and subscribe. I'd love to hear your thoughts in the comments.